Okay, I don't see anybody else in the waiting room. So as soon as I said that, somebody else entered the waiting room. So we'll let them in. And as we're doing that, we will welcome everyone to this Business Resiliency Task Force webinar. It's been a while since we've done one of these, and it's kind of nice to be able to offer some information thanks to one of our wonderful partners, MNP. Agreed to try and help us sort through the changes to the Canada Emergency Wage Subsidy program. And I know it's a program that has helped a lot of businesses and probably confused a lot of businesses along the way. And we are thrilled to have Tracy and Heather from MNP be able to help walk us through some of the changes and what they mean to us. We also welcome Lindsay from MNP, who's helped us set up this presentation, and they've been a terrific partner for the BRT throughout this all thing that we've been going through for the last 4.5 months, whatever it is now. We'd like to thank the City of Grand Prairie and the County of Grand Prairie for being our partners in the Business Resiliency Task Force. We do still have a number of resources and links for information on our chamber website. There's a tab for the business resiliency section when you go on the website. So it's grandprairiechamber.com, and you're free to visit there. We've had a number of people visit, and we thank you for your positive feedback and comments on that. And other than that, we'll have questions be able to be asked for Tracy and Heather once they've done their presentation. If you can just acknowledge that you have a question, or if you want to type it in the chat box, and then we can let them know that there are questions in there, where we can do it that way as well. So without any more of my babbling, we'd like to introduce Tracy and Heather from MNP, and we look forward to their presentation. Welcome.
Thank you, Tom. And thanks for having us, and thank you everyone for joining us, and hopefully we will add some more light to the new changes, but probably if you're like me, it will just confuse you a bit more, and you'll get to read it again and again, and hopefully a few times you'll understand it. But the changes have been quite positive that have been made, so we'll get started on that. So I think, and just our normal disclosure that all the rules are changing, so we've kind of got today's information for you, but please make sure you are staying tuned and asking questions as you work your way through all of this stuff. And this is how I feel most of the time about all the wage subsidies. So if you're feeling the same way, please, you're part of us, and that's how you should feel. But hopefully we'll add a little light here for you. So we're gonna kind of go through a brief history of kind of how we got to where we are today, and I'll cover that a bit, and then Heather's gonna take over with the changes to the CEWS program, and then a little bit of application and planning to do, because they did have a few things to think about now as we go through the subsidies and how things are going to be claimed. So kind of a history. So January is kind of when COVID first arrived, and as you can see, every month, you know, especially from March, there was a whole bunch of announcements by the government. April and May, not so many, but you know, when we think of this program being not very old and how many changes and how much everyone has had to learn, it has been quite a steep learning curve for all of us to know, you know, you do the CEWS subsidy, there was the temporary wage subsidy in there for a while. It's gone now, but there's still some paperwork to follow up with that one. The CURB program as well, how that interacted. And now we know that as of July 17th, they now have extended the program till potentially the end of December. So this will be with us for a bit longer. So kind of where this started, they first announced the temporary wage subsidy, and this was back in March. And to be eligible for this one, you had to have employed one or more individuals in Canada, had an existing payroll number with with the government and been paying salaries, and it existed for the period from March 18th to June 19th. And there was there was a few limitations on what companies were eligible, but the maximum subsidy of $13.75 per employee up to $25,000 per employer was where they started with this, and then soon realized that this was not sufficient for what the government needed to support businesses with. So this subsidy, if you haven't applied for it and you found that you don't qualify for the CEWS, the other wage subsidy, you can still apply for this. They've put out a new form now, and it is available on Revenue Canada's website. It's called the PD27, and it will have to be filed to Revenue Canada by the end of the year if you have claimed anything with the temporary wage subsidy. And this allows Revenue Canada to reconcile your T4s. Because there is, with all of this, it does impact payroll. And when it comes to doing payroll this year, January and February are going to be two very busy months, I think, for anyone involved with payroll, getting all these subsidies recorded properly. So again, there was no real apparent deadline to this, but from what we've understood, it will have to be done by the time you're filing your T4s this year. So as I said, that they discovered that subsidy just wasn't enough and wasn't providing enough support to businesses. So they brought in the Canadian Emergency Wage Subsidy, the CEWS program is how I've been referring to it. And this was up to 75% wage subsidy, and it started back March 15th, 2020. And the rate was applying 75% to basically the first $58,700 of earnings per employee. So the maximum you could receive was $847 per week per employee, as long as they were receiving about $58,700 per year as their wages. So this program started off as a 12-week program, March 15th to June 6th. This is kind of when we thought we would be over with the CEWS, but they've extended it. First, they announced it was going to be extended to August 29th with the existing kind of program that they came out with. And now they've actually changed the rules a bit for the July and August period and have extended it to December 31st. So not as temporary as all of us had hoped, but as businesses will need it, we're glad it continued on. So again, the key criteria from the first, when the subsidy was announced, it hasn't changed. We do have to look to make sure people are eligible employees, eligible entities. We have to look at a qualifying revenue over the qualifying periods the government has provided, and eligible remuneration that's been paid. So we'll get into more details, and Heather will cover details on this, but that part of it has stayed the same. But again, the legislation is very complex and it hasn't gotten any easier. And they have kind of changed. Some of the changes they've made have gone back. Some of them are just from a date going forward. So you really have to pay attention to what period you're in, how you're completing the wage subsidies. So the original tests as well, they kind of looked at an 85% revenue versus a 70% or less. So they kind of, it was an all or none. So if you didn't meet that revenue reduction, then you weren't getting the subsidies. So they have changed that, which Heather will talk to here. But again, we have to really watch, originally it was an all or none. You're either in the subsidy or you weren't. And then with that, and the calculation, and this we just wanted to give an overall recap of it. It was the amount of the subsidy, and for the first few periods, it was less whatever you claim for the 10% wage subsidy, less any amounts received by an eligible employee for each of the week under a work share benefit. And then you could add on the CPP and EI contributions that you were making for the employees if they were on leave with pay. So you could, in a sense, with the first subsidy, receive for some employees that were off work with pay, you could receive almost 100% of their pay as a subsidy. But again, that was the original one. Now things have changed a bit going forward. So it's really the amount A that has done quite a few changes. And just as a recap, with the original program, the amount in A was kind of set based on a baseline remuneration and a current remuneration. And there was a difference between, so your arm's length employees, so your arm's length are people that you're not related to, versus non-arm's length. And when we talk about non-arm's length employees, that's really the business owner, their spouse, and their children. They fall in the non-arm's length category. So depending upon what the employee was and how they had been paid in the past and what they were making during the subsidy period, you could end up with a different subsidy for each of them. Again, the maximum that they could have received would be $847, but in our example, someone that was getting paid $750 per week, as long as they were making that prior to the subsidy coming in, they could still potentially get the maximum subsidy of actually what you were paying them per week. So again, didn't want to get into a lot of detail on the calculations here, but this is kind of just to lay out how the existing program is so that you can kind of keep that in mind as we go through the new changes. And I think that is, so that's kind of our quick recap. Now I'll turn it over to Heather and she can fill you in on all the new changes.
Thanks, Tracy. So I'll do my best to navigate kind of what we refer to as version 1 being the original cues, and version 2, which we're now referring to the new changes and the updates that lead us here to the end of the year. So just overall, well, that didn't change on me, one sec. There we go. Overall, I did just as some high level kind of changes or highlights. Now, any eligible entity that has a decline in their revenue is going to be eligible for the subsidy. There's a sliding scale as to how much they are eligible for, but everybody is now can be included as long as there's been some sort of a revenue decline for period 5 onward. The sliding scale for the subsidy can be from $0 all the way up to $960 per week if they meet the top-up criteria, which we'll go through together. There's no minimum decline, so everybody's eligible, as I mentioned. So now the revenue calculations are becoming even more important than under version 1.0. The revenue is going to be used to calculate this base subsidy, which is what we're used to, is the base subsidy was used, or the revenue decrease was used to figure out what your base subsidy was. So if you've met in the original program, if you've met the 30% decline, you were eligible for the base subsidy. Version 2.0 introduced a new top-up subsidy that can be received, or you qualify for, if you've met a 50% decline in your revenue. And this is going to be calculated based on a 3-month average reduction in your revenues. So there's one more revenue test that has to be calculated for each period if you're over the 50% drop in revenue, or a revenue decline of 50% or more. So your revenue reductions now are going to play a part in figuring out the total amount of your subsidy as well. There's different rules if you're over 50% in a decline versus if you're less than 50% decline. And it's going to be a sliding scale based on your actual revenue decline. Hence the reason I say the calculation of revenue reductions is even more important with this new version 2.0. There is some flexibility allowing us to use the old rules, or relying on the 30% decline in revenue for periods 5 and 6. And for periods 5 onward, there's now a different test for baseline remuneration, and it's only going to be relevant for non-arm's length persons. So the shareholders, the people related to them, as Tracy just mentioned. There is different deeming rules that we're going to look at today. And eligible employees can now be without remuneration for more than 14 days, which was one of the things that precluded an employee from being a part of the subsidy rules in the old program. And there's also been some changes to furloughed employees as well that we're going to take a look at here. So all through our presentation, you're going to see us referring to the qualifying periods. So version 1 dealt with really periods 1 through 3. And version 2 now extends it all the way out to November 21st, 2020. And with the ability, the legislation has the ability to extend it right to the end of the year to December 31st, giving us one more period. So when we're looking at our prior reference periods, this is what we're going to compare our revenues to determine if we've had an adequate decline in revenue. So for our prior reference periods, we can always go back and look at the same month of 2019. So for example, if we're looking at an April calculation, April 2020, we can go back and look at what April 2019 revenues were and use that comparison. Or we can choose to use an average of the January, February revenues under 3 circumstances. For periods 1 through 4, we can use that January, February average if we weren't carrying on a business in March of 2019, or if we choose to file an election because it's more preferential to use that average. Or again, for period 5 onward, we can use an election as well to look at the January, February 2020 numbers. We can choose to elect differently for periods 1 through 4 than period 5 onward. So baseline remuneration, originally under version 1, this was a very big limiting factor to the amount of the subsidy that could be received for employees. Now under version 2, it is more so, it only really applies to your non-arm's length employees, so shareholders, etc. When we're calculating baseline remuneration, originally we were only looking at the periods of January 1st, 2020 to March 15th, 2020. Now under version 2.0, we have the ability to take a look at a couple of different periods if we file a special election. So we can take a look at the March through May period, or we could also take a look at the July through December period. And what this has done is it's allowed us to take a look at these different reference periods to account for people that may have seasonal employees or may only pay remuneration at the last half of the year. For example, maybe a farmer or somebody that pays themselves prior to the December year end. So as I mentioned, the baseline remuneration was very much a limiting factor for the original version 1.0 of the Qs for periods 1 through 4, and that was for all employees. So that was going to be our top end of our subsidy unless the current period remuneration had increased for arm's length employees. Now it's only going to limit our subsidy for people that are non-arm's length. So there's been a bit of a shift in the rules with respect to our baseline there. So eligible employees, there is not a lot of change here. We're still dealing with somebody that was an individual employed in Canada. So residency of the employee or citizenship of the employee doesn't matter as long as they were employed in Canada. It had to be in respect of a qualifying week. They had to be employed by an eligible entity, which we'll go through the list of eligible entities here in a sec, in a qualifying period. So one of those periods 1 through 4 or 5 onwards. And here's the big change in version 2.0. Originally, if they were without remuneration for 14 days or more in any period, they didn't qualify as an eligible employee for that period. Now, that rule has been taken out, and for periods 5 onward, there's no preclusion for anybody that has been without remuneration for the 14 days. And this was just tied to stop the double up of people getting the wage subsidy and the CURB.
Excuse me, Heather, can you speak up a little bit? I've had a couple comments of...
Oh, sure, you bet.
Pretend you're yelling at your kids.
I never do that.
Oh, okay, that's just me.
Sure, you bet, thanks. So for eligible entities, there hasn't been a significant change here. Is that better for sound? No complaints? So for eligible entities, there's not a lot of change here. In version 1.0, there were some groups that were excluded from the very, very first version. But there was some announcements that came after the fact that then looped them in. And some of these people included the First Nation entities or entities owned by a First Nation, some specific partnerships with different ownership structures, amateur athletic associations or private schools or colleges. Version 2 includes all of these entities as well. So no change subsequent to the previously prescribed entities announced. So one of the fixes that we saw in version 2 relates to cost share arrangements. So just as a little bit of background on cost share arrangements, we often see this with medical professionals. You have a group of doctors, for example, all sharing a space and all sharing staff. And they have one company that deals with payroll for those employees. Their only revenue coming in is from all of the professional corporations or the doctors to contribute their fair share of the payroll for those employees. And that's the only activity in those entities. So in version 1, the problem with this was it was the professional corporations that would have had the decrease in revenue, and they didn't have the employees. The employees were housed in a different company, and so the one with the payroll or the employees didn't have the drop in revenue. So there was no matching of those two, the entities. So this was a problem where we had a lot of people that didn't qualify just based on this technicality. And this is something we took to the House of Commons Standing Committee and had asked for a fix. So the fix that was presented in version 2.0 is that the minister has to be satisfied that on March 15th, 2020, there was a payroll number that was administered maybe by a service provider on account of this other entity, and it had to have employed more than one or more individuals, and obviously have met the revenue tests as well. So this was a good change for us to see, and one that us as MNP was very happy to see the change. So the revenue reduction percentage, so under the original version, it was a hard and fast rule that if you didn't meet the revenue decline, you were out. So it was either in or out. So for period 1, if you had a 15% revenue decline, you were in. In periods 2 and 3, it was the 30% revenue decline. So for example, if you had in period 2 a decline of 29.99%, because you didn't actually meet the 30% revenue decline, technically you were out.
Heather, we can't hear you.
Okay. How about now, Tom?
Yep.
Okay. I'll just lean a little closer and speak a little louder.
Yeah, something just cut out when there for a little bit, but okay. Go ahead.
Thank you. So for version 1, just to backtrack here for a second, I'm not sure where I cut out there. So version 1 was a hard and fast rule. You were either in or you were out. If you didn't meet the necessary revenue decline for periods 2 and 3 of 30% or 15% for period 1, you were out. So for example, in period 2, if you had a 29.9% decline, you were out. There was no ability to access the subsidy whatsoever. But if you had a 30.001% decline, you were in. So there was a very, very hard, fast rule, either in or out. One of the things we took to the standing committee on this as well was to introduce a continuum or a spectrum of declines and have the subsidy decrease as your revenue start to increase as well. And this is what we're seeing in version 2.0. So it allows for a continuum or a sliding scale of revenues that are subsidy based on your revenue decline. So for period 1 through 4, there's no change to these rules. It's still your hard, fast rule of 15% for period 1 or 30% for 2 and 4, 2 through 4. But for period 5 onward, if you have a greater than 50% decline, you're going to receive a greater subsidy and also be eligible for the top-up. If you have a less than 50% decline, you're going to be tied to the amount of the decline or the percentage decline of revenue. So again, going back to those highlights, this is where our revenue calculation becomes so very important, because your subsidy is actually tied to that decline. But on this continuum, every entity is going to be eligible for some sort of a subsidy, and it's just as long as they've had a decline, every entity is eligible. And it just is how much of a subsidy you're eligible for, and that is dependent on this sliding scale. So again, this revenue reduction percentage, it's going to help us determine what our subsidy is for periods 5 onward. And this is going to determine the base percentage for our Q's claim. If we're over 50%, we've maxed out this base percentage or this base calculation, and we would be eligible for the top up. If we're between the 0 and 50% reduction, that's where we need to calculate the exact percentage reduction, because that's what will be used to figure out our subsidy. Our top-up reduction percentage, however, is going to be based on an average of the last 3 months. Oh, skip ahead here. Of the last 3 months' revenue. And so it is going to be a sliding scale, or a period of 3 months of the previous 3 months always, to figure out if you are eligible for the top up. And you're only eligible again for this if you have more than a 50% decline in your revenues. And that's going to be based on this average amount. So if you're calculating your July subsidy and trying to determine if you're eligible for the top up, you'd go back and look at the previous 3 months, so April, May, and June, and figure out your rolling average for those months. And that would be what you'd use to determine your July subsidy and whether you are going to qualify for the top up. We're going to compare that reduction again now to your January, February 2020 period, or to the same 3 calendar months of 2019. So if you have a greater than 50% reduction in your revenue decline in the prior 3 months, your top-up subsidy is going to be calculated based on the formula you see on your screen. So it's going to be 25% of your top-up subsidy of the $11.29, or 1.25 times your 3-month average revenue decline minus 50%. So lots of math at hand here to navigate. You're going to reach this maximum when you hit 75 or a 70% reduction in your revenue, and the top-up maximum is going to be the 282.25. So that's where we max out. So revenue reduction really, really matters between the 50%, which is where you start getting your top-up, and the 70%, which is where you max out on it. Below that, no top-up. Above that, we've maxed out. So when we're looking at our revenue reduction, this just lays out what our maximum subsidy can be. So you'll see in our first column, under version 1.0, we maxed out at 75%. That was the total subsidy we were eligible for. However, under the new program, or version 2.0, if we're greater than 50% revenue decline, and we are eligible for our top up, we could get up to 85% in these next few periods. And all the way down to, we have a sunlight period, or a sunset period, I'm sorry, it's going to reduce all the way through to November, where at the end of, or the period for November is going to be a 45% subsidy. So the rules on furloughed employees have also changed. So a furloughed employee is somebody that is not ordered to work right now, but they are still getting paid. They're not laid off. There's no temporary layoff. We're continuing to pay these people even though they're not coming into the office. And so the subsidy was intended to still help us cover the wages for these people, so that they didn't go on one of the other programs like the CURB or the EI program. So periods 1 to 4 haven't changed for the furloughed employees. The CPP and EI are still being refunded. You still get that extra kicker. For periods 5 and 6, there was a special rule that was implemented, and there has to have a revenue decline in the current period or in the prior 3-month average revenue, and you can get a 75% subsidy on the wages paid. The new legislation for periods 7 to 9 contain a special rule to help us with the calculation. And for furloughed employees, it's going to be the least of these amounts. It's going to be your eligible remuneration paid for that week, an amount that is determined by regulation. And those regulations have yet to be released. So that's going to probably be one of our big limits with respect to this. And we don't have that information yet. And we expect to hopefully see that from finance here sometime soon. So this chart just helps us navigate, or helps us visualize, I guess, what the maximum subsidies are going to be. So in the first few periods, our maximum subsidy was $847, and that was the total subsidy we were eligible for. Now under this new program, if we receive a top-up percentage, we can go all the way up to $960 for the first, for periods, 5 and 6, and then it continues to slowly drop down all the way to $508 at the maximum in the last period in November. So again, just outlining what our maximum subsidy is. The green boxes are showing us where our top up, we are assuming we're getting that top up. So if we have 100% revenue decline, and we've received our maximum subsidy come the end of the program, it would be a 45% top up is where we land at. So again, just that sliding scale of subsidy as hopefully people's businesses start picking back up. If we have less than a 50% revenue decline, we see a much lesser subsidy, and it's going to decrease. The amount of the subsidy is completely tied to what your revenue decline is. It's factored based on your revenue decline. So for example, if you have a 10% decline in your revenue, you still are eligible for some subsidy. For the first period, it's $135, and it goes down to $45 in the October-November period. So for people that are eligible for these smaller amounts of the subsidy, there's going to come a point that you're weighing out whether the cost of doing the application is worth the amount of the subsidy or the benefit. $45 times, 1 or 2 employees may not warrant it, but if you have multiple employees that would be eligible for the $45 subsidy, the benefit's likely there. So our deeming rules also changed with respect to the new program. So just to go through what our rules were for periods 1 through 3, if you qualified for one period, so if you qualified for period 1, you were automatically eligible for subsidy for the next period, or deemed to have met the test in that period, regardless of what your revenue decline was. So if you met for period 1, automatically you were in for period 2. If you met for period 2, automatically you were in for period 3. And if you met for period 3, you were automatically in for period 4. These deeming rules stop at period 4. And for periods 5 and onward, it is going to be a completely different set of deeming rules. So now, instead of on a look forward basis being qualifying, we're able to look backwards. So where our revenue reduction percentage in the current year, or current period, is less than the immediate prior period, we can go back and use the prior period revenue reduction percentage for our calculation. So if during the current month, for example, if you have a 35% reduction in revenue, but last month you had a 45% reduction in revenue, we can choose to look back and use that 45% reduction to figure out what our subsidy is for the current month. So what that's doing is it's giving us a little bit of certainty in knowing that because we've met the prior period, we know that we're going to have a minimum subsidy equal to whatever that 45% was based on. It's allowing some certainty for people to continue to keep their employees and have a little bit of information on what their cash flow might be for that period. The deeming rules don't help us though with the automatic top-up. You must qualify for the top-up for each and every period based on that 3-month sliding scale that we talked about. But you're not, and also not required to use the prior month percentage if your current month reduction is higher. So a couple of other items to note. For revenue calculations, we were eligible, or we were able to use either a cash or an accrual method of calculating what our revenue was. When this election was made for it had to have been made for the entire 9 periods. There's no changing it even under version 2.0. So if we've chosen to use the accrual method, we use the accrual method for all 9 periods, likewise for cash. If we're using the accrual method, it will be in accordance with generally accepted accounting principles. And so we must follow our regular accounting principles to figure out our accrual revenue. A couple of the things that were missing out of version 1.0, and these were things that we took to the standing committee as recommendations as well, was if we have an asset sale or if we've acquired a new business, that we don't have revenues in a prior reference period to be able to calculate our subsidy based on. So if I bought a new business on March 1st, 2020, I don't have January, February revenue to go back and compare to figure out my subsidy. And I don't have March, April, May 2019 revenue, for example, to go back and look at the same month of prior year. So these businesses were just not eligible for the subsidy under version 1.0. So now what they've done is they've amended this, or they've introduced a new rule, I guess, with respect to asset sales or new businesses. And this is retroactive. It applies to all periods, 1 through 9. If we've bought all or substantially all of the assets of a business, we're able to look back and use the revenue from the vendors. So the prior year revenue that would have been for that business, we're able to look back onto to do our reference calculations. If this is the case, we do have to file an election with the CRA with respect to this. And we have to have, it could be a joint election if the vendor continues to exist and operate a business. If the vendor no longer exists, it's just an election that must be filed by the purchaser only. So this was good news for people that that maybe bought a business since the beginning of 2020 that didn't have a prior reference period to look at. Another big, I guess a big win for changes with respect to version 2.0 are with respect to business combinations or amalgamations. So previously under the old rules, if we had a business that had amalgamated or was squished together, we weren't able to go back and look at both companies' revenues in order to determine what our revenue decline was. Now we're able to look at both companies on a combined basis for the prior reference period. So other important items to note with respect to these, all applications must be made by February 2021. And there is the ability to, there are audits that are ongoing with respect to the applications. A lot of clients or a lot of applicants are receiving phone calls from CRA auditors upon the application if they have questions. We had one application that was submitted that literally within 1 hour, we had a phone call on. Lots of them are being submitted and cash is being deposited if it's direct deposit within 2 days. The timing has been, the turnaround of these things has been really good. We do expect to see additional audits coming this summer. And there has been some auditors that have been redeployed from other areas of CRA that are looking at the queues. There's a lot of complexity that comes with these applications, and it's a lot of information for everybody to maintain. So if these applications are audited, the things they're going to be looking for are what your revenue reduction calculations are, your payroll calculations, that sort of thing. So we need to make sure that we're keeping all of that information to substantiate our claims. So what does this mean for you and your business? So it's a really great time to review your eligibility if you were previously not eligible for the old rules. Everybody is now eligible, or virtually all businesses will now qualify. And so it's a good time to review that. Recognize, as Tracy mentioned earlier, these rules are very complex and they're hard to navigate. As a firm, we've spent hundreds and hundreds of hours navigating these, and it still seems like every day either new information pops up on the CRA website in the frequently asked questions, or new legislation comes out, or a new spin on a question that we've seen before comes on, you know, how vacation pay is dealt with or how bonuses are dealt with. So they are complex and hard to navigate, and so don't feel like you're alone with that. And yeah, eligibility has just opened up as well. So as I mentioned, make sure you're maintaining good records, looking at, the auditors will be looking at what your calculation of the temporary wage subsidy was, because that plays a role in the first few periods. What your calculation of your decline in revenue was, your baseline remuneration calculations, and your payroll calculations as well. So keep good files with respect to this. So as I mentioned, throughout, we as MNP went to the House of Commons Standing Committee and made some recommendations on behalf of our clients and on behalf of small business. And these are the things that we took to them to review and take a look at. Phasing out the program over time, eliminating the all or nothing revenue decline requirement, the cost sharing changes, the asset sale changes, and a higher subsidy with respect to people that are most impacted. And in this version 2.0, we've seen most or all of these things captured. So thank everybody for their input with respect to this, because it's you guys that are bringing these issues to light as well. So here at MNP, we've created a business advice center. The link there, or the website, is on your screen. It is being updated as information becomes available. So feel free to subscribe to regular updates. There, we'd love to send you information. And that's where the question slides pops up. Has there been any questions here?
Okay, we do have a couple. I want to thank Tracy and Heather right off the bat for the information. And I liked accounting in high school, but I wouldn't have passed if this was on the exams. I know that much. But all right, so to the first question, we used Qs for May, but not June. July now qualifies under the new rules, but not clear. Are we still comparing just the 1 month of July 2020 to the previous July 2019? The person does not quite get the reference to 3 months.
So the reference to the 3 months, so you would, if you have a decline, as long as you use the, sorry, I'll speak up again. As long as you use the prior year reference period instead of the January, February reference period when you did your original claim, you are able to just look back at the July 2019 revenue and see if you have the decline. If you have a decline there, you would be eligible, even if you didn't apply for, I believe you said it was June, Tom. The 3 month floating one, or the 3 month rolling one, is only for that top up subsidy.
Okay, if that didn't quite answer the question, to the person that asked that, then just let me know in the chat box, and we'll get some more clarification. The next question: under the safe harbor rules for periods 5 and 6, do the deeming rules still apply? For example, if August revenue is down 27%, but July revenue was down 33%, does August still qualify for the version 1.0 75% subsidy using the safe harbor rules?
With that one, it's kind of picking whether you're going to use version 1 or version 2. With July and August, you can have a choice of picking which rules you're using. So then with the, I guess if the August revenue decline is only 27%, you would, if you're going back and using the 33% for July, that would be in the new rules, version 2.0, and that wouldn't qualify you for the 75%. That would qualify you for the new rules, which is the 60% revenue decline for July and August. So these are, I guess, some of the issues that we have seen come up where you're really having to do quite a bit of math. And until you've got kind of your spreadsheets done and some of these numbers calculated, you won't know which way you should choose. And that's kind of where we've run into too right now with our advice is, okay, at what point do you stop trying to figure out which, are you in version 1, version 2, and which rules are you using? So I would say, you know, that question very much highlights the, you know, which version is better for that client to use. And, you know, sometimes it is looking a little deeper too as to what their employees are making and where the two rules will happen. So sorry, don't really have a really easy answer for that one, but you know, that does highlight the complexities of where we're at right now.
Yeah, I'm not sure there are easy answers for any of this, but appreciate that explanation. Tanya has a question.
Thanks, Tom. And thanks so much, ladies, for presenting for us today. It was really good. It's definitely happy that the governments have been working with MNP and with organizations like the chambers to try to get the rules, you know, better for businesses, but it's definitely not simple. So this might be a simple one though. I just wanted to go back to the temporary wage subsidy. So that 10% that was originally introduced. So for our business, for example, we didn't actually hold back that 10%. But you have to claim it, right? For the first couple of periods, you have to claim it as if you did hold it back. So the way I understand it, there's going to be a claim form that come out to get reimbursed for that 10% wage subsidy. Is that available yet, or do we still need to keep an eye out for that?
I haven't seen anything on that, and from what we understand, there is the new form out where you can self-report and report what you are claiming for the subsidy, and you can request then when your T4s are being done that the amount either be applied to next year's withholdings, or you actually get a refund check back to you in the mail.
Okay, so sorry, that was on that PD 27?
PD 27, yeah. It allows you to fill out what you were claiming for it, but again, doesn't allow you to get the money back yet at that time. And from what we understand, that'll be part of the T4 process. But again, I would just stay tuned because something should be coming out soon with that.
Okay, thank you.
There's a comment about are we able to receive a copy of this PowerPoint? There were quite a few great charts so we would like to use as references. I know we're recording this and we'll be able to replay it. I'm not sure what the ramifications are or the process is with MNP. I know a lot of it is proprietary, but I imagine if they contact you folks that you'd be able to provide them with some of that information.
Yeah, absolutely. We can send a PDF version.
Appreciate that. Okay, I saw something yesterday on CRA online for the TWS election. I'm not sure if that's a question or a comment. April, if you wanted to unmute, you could maybe expand on that, or if it was just something that you just commented.
Sure. That was just a comment in response to the question that was asked that Tracy responded to. I did see something yesterday on the CRA online account. It's just right under the queues information, and there is a link now where you can, I think you can go and elect for that TWS, whatever it is, election.
The election there.
Okay,
perfect.
Thanks,
Thank
April.
you.
There was a question about who do we email to get a PDF. I imagine either Heather or Tracy, their addresses are up on the screen there.
Yeah, you bet.
They'd be able to help you out. Okay, if July revenue was down only 23%, but June was down 35%, is it correct that I can claim the subsidy for July under 2.0 using the prior month revenue decline?
So you'd go back. So the June,
go ahead, Heather.
So the June was down 35.
July was down 23. June was down 35. Can they claim the subsidy for July under 2.0 using the prior month revenue decline?
Yeah, so under the, oh, sorry, I just lost. I was running back to my Deeming Rules here just to be sure I don't lead anybody astray. So for periods 5 onward, we're able to use the new Deeming Rules. So yes, that would work.
Okay.
Now I've lost my screen completely. Okay, that's okay. Yeah.
It's all right. Any more questions from the group? I'm not even sure what time it is. Kind of lost track of time here. We're about, we still probably have about 10 minutes or so. If there's more discussion or anyone wants to ask anything more of our pros from MNP.
Yeah. I'd like to, I guess, just add right now too, is that we are hoping to have some more question and answer periods. We're not sure exactly when we'll have that, but we'll be sure to let you know, Tom, when we're arranging that, because we do understand, you know, it's a lot to digest right now, and until people actually start working with the new rules and get into the numbers, you know, that's when I start having all the questions, is when you start working on it. So we're hoping to have another question and answer session just to kind of just have more of a discussion and people to share their thoughts and questions.
Yeah, you bet. Couple more trickling in here. Would the deeming rule apply to us? We qualified in May, but not June, but now July is down.
So qualified.
I guess with that one, then your July, because now you can be either in the new or the old rules. So if July was down 30% or more, you could still qualify under the old rules. But if July is only down, say 20%, you would now apply with the new rules. Whereas in the past, you wouldn't apply in July, but now with the 2.0 version, you would apply or qualify.
Okay. There's a question from Jasmine regarding cost share. Jasmine, go ahead.
So we assist a set of doctors with what you talked about, the cost share. So they all put into one account. It has its own payroll number, has for many years. And what they do is they just put in what we call equity deposits. So they had already approached us and asked us if they would be eligible to have their staff covered for the CEWS. And at the time we were like, well, no, because we would have to have proof from your accountant from the professional corporation side, but how would we handle it now with the new 2.0 rules? Do I still need to have the accountant show me the loss of revenue from each of the doctors that contribute?
Revenue decline would have to be based on the professionals. So in order to do that calculation, Jasmine, you would need, I believe, that information. Because it's that whole mismatch of payroll to revenue, and that was the original problem. So yeah, I think that you would need that information on the PCs.
Thank you.
Mm-hmm.
Question, so if we originally used the average of January and February 2020, we need to carry this into version 2?
Yeah.
No, that one's an easy one. You can actually do a different election for version 2. So if you elected January and February for the first 4 periods, you can start period 5 if you're under version 2 and do just the prior, the same month in the prior year. But once you've elected that, you have to do the same for periods 5 forward. So 1 and 4 can be one reference period. Periods 5 and on can be a different reference period, but they have to all be the same in each group.
Okay. Are there any other common questions or concerns that you folks get that seem to pop up a lot? Or is there a whole list? What's the most confusing thing for people?
I've been seeing a lot of questions with respect to how to deal with people's vacation time that's getting paid out. That's been a common one that's coming across my desk. And it all comes down to, I never realized people had so many different versions of doing vacation pay as they really do until now that we're seeing this. And it comes down to how their vacation works. So if it's a type of vacation where you get paid out on every check, that just becomes part of your qualifying pay during a qualifying period. If for some reason they're getting paid a lump sum just at request, you have to go back and look at when, I guess, that vacation pay would have been earned to determine if it falls into a qualifying period. That one's been causing a little bit of complexities, I would say, there.
Cool, appreciate that. Any other questions? Again, we have about 4 or 5 minutes left in our time slot here. There was a thank you to MNP and for hosting this event, and we do appreciate you guys taking the time to do this, and we appreciate everyone chiming in on this call. Like, we have almost 60 people on the call, and it's great to get that feedback from the community and from people, and sharing ideas and information, because that's the only way we've been able to figure this thing out for the last 4.5 months, is everybody kind of working together and sharing their thoughts and concerns and successes and all that good stuff. So
I just wanted to add one more thing, Tom, before we wrap up. just that we can share, we'll just broadly share the PDF version of the slideshow with everybody. So when the recording is available, we'll send the PDF of the presentation as well. And then that way everybody doesn't have to individually ask for it. So.
Okay.
Thank you.
One more question. Do benefits paid monthly, disability insurance, count as regular pay that qualifies?
So that should be part of your regular regular remuneration, so it should qualify for you.
Okay. I'll ask for one last round of questions. Let's steal this from the president of the Alberta Chambers. Oh, there, yep, oh, that's a thank you. Okay, so going once, going twice. All right, thank you, Tracy, Heather, Lindsay, MNP. Our thanks to the city and county for working with us at the chamber on the task force. And it's all about business resiliency, and it's what makes our region great. Everyone working together and showing why we're leaders in the province. And we've been doing that since day one, and we'll continue to do so. So thanks everyone for joining us. We'll make the information available and share that with you. And hope you have a great day, great weekend, and let's keep doing what we're doing.